Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures in the red to kick off the week. Amid growing concerns on Wall Street that President Trump is serious about his threats to fire Fed Chair Jerome Powell, sparking a sell-off in the dollar and treasuries. The so-called Sell America trade is gathering steam, sending gold to a record high. Meantime, Trump's trade war is in focus as China threatens retaliation against countries that are striking deals with the U.S. that could hurt Beijing's interests. This comes as the Trump administration is reportedly planning to use tariff negotiations to pressure U.S. partners to limit their dealings with China.
Plus, earnings front and center for investors this week, with more than 140 companies out with results, including Tesla and Alphabet. Tesla will report after the bell Tuesday. Wedbush analyst Dan Ives calling this a code red moment for the company if CEO Elon Musk doesn't take a step back from Doge and focus full-time on the EV maker. And Google parent company Alphabet reports Thursday, bringing back into focus the AI trade and if big tech's AI investments are paying off.
And Pope Francis, an Argentine Jesuit who became the first Roman Catholic pontiff from the Americas, has died. The Vatican making the announcement this morning, tributes pouring in from around the world. Francis made waves during his papacy as a reformer who often rattled the Catholic Church's most conservative quarters, but found popularity among progressives who embraced his championing of social justice efforts. His death comes after spending weeks in the hospital recently fighting pneumonia. Pope Francis was 88 years old.
U.S. stock futures are falling this morning. Alongside the dollar and treasuries, experts warning the trade war and President Trump's threats to fire Fed Chair Jay Powell are scaring foreign investors, boosting the, quote, Sell America trade. Our very own Josh Schaefer joins us now just to break down what's at risk with the Sell America trade and how it's really being enforced.
Yeah, Brad. So what we've seen basically over the past month is whenever there's been increased signs of instability, I would call it, overall here in the U.S., you've seen a flight from a lot of U.S. assets. So this morning, it seems to be a lot of folks talking about President Trump potentially being serious about firing Fed Chair Jerome Powell. Again, another sign of perhaps instability in things happening here. So what that trade has really looked like is U.S. dollar index has gone lower, so you now have the U.S. dollar index at about a 3-year low. It's been selling of U.S. Treasuries, right? So you see the 10 years higher this morning, 30-year higher. That's been, again, the move that you've seen over the last month. And then you've seen just a move out of U.S. equities. So if you zoom out and really look year to date, stocks outside of the U.S. have performed better than U.S. stocks, right? The S&P 500 down this year. You look at a rest of the world ETF, that's actually up on the year. So overall, it's just been this move away from U.S. assets into some other assets. Right now, I think perhaps strategists are more calling it a temporary move and maybe not a long-term investment strategy and an overall shift of what's going on.
And it's important to note, obviously, that legally there are protections for the Federal Reserve Chair. The administration has been looking into ways to fire the Fed Chair since 2018. They still haven't found a way to do that, but that won't stop them from looking. But Josh, that does make me think that this morning's trade is maybe a little bit much ado about nothing. We had a shortened week last week. Sure, America sell, whatever, but it doesn't seem like there's this conviction in the long-term loss of America.
No, and if there was conviction in the fact that President Trump could fire Fed Chair Jay Powell,
we'd already be in a bear market.
I think markets would look a lot worse, right? If we were really starting to price in that reality, I think you would see a lot more chaos in markets this morning. But yes, Maddie, to your point, I think strategists have started to argue when you zoom out and sort of look at this quote unquote Sell America trade, people are starting to wonder if we've gone perhaps too far at this point, and maybe when is the rotation back in to U.S. equities? Again, going into the year, you sort of just had this positioning imbalance. Everyone was expecting the U.S. to outperform again. That was the consensus call. So when that doesn't start happening and you have shifting of expectations, makes sense that you get big outperformance for rest of world stocks. Now that we're 3-4 months into that, consensus has been it's a mess over here. Oh boy, everything's so bad. is there a snapback the other way, right? So Morgan Stanley's Mike Wilson was making a little bit of that point in his research over the weekend. He was pointing to earnings revisions, saying that you're starting to see earnings revisions perhaps maybe bottom in the US while they're continuing to get worse in other countries. So maybe that's one thing that you can sort of argue that could help there.
Well, it's really what we're going to see over the rest of this earnings season as well. Do we see companies come out like a United and say, we're going to give you 2 ranges. We'll give you 2 areas of guidance.
That'd be nice if everyone did that, right?
I mean, it would show that they certainly do have
more
a handle
clarity
on their own finances and own modeling as well, going forward for a range of scenarios versus companies that say, okay, we have no clarity beyond 60 to 90 days, and we're not really sure exactly how the consumer is going to react, or on the business-to-business side, how our core client bases are going to continue to spend, even if we do have multi-year contracts with them. Who's going to re-up those contracts? And that's the larger.
And I think with earnings too, specifically, I think you're going to get a great example tomorrow night with Tesla, right? That stock is down 40% this year. The stock already sold off on bad deliveries for the first quarter. The bad news is pretty much out there. They're not expected to have a great quarter when they report, right? Does the stock sell down more? Or have we done enough selling? Is Tesla down 40% enough for investors to listen to a call where Elon talks about robots in 2035 and people get excited again? I think that's the interesting earnings question this week as we start to get into big tech, is have these companies sold off enough, and have we priced in some of the bad news at this point, and perhaps bad news doesn't just send another stock selling off again. That's going to be interesting to watch.
And how high is the bar this earnings cycle as well for some of that storytelling that tends to happen on calls? Josh, thank you so much. Really appreciate it. Well, as we were discussing, the so-called Sell America trade gaining steam this morning with the dollar down against every other G10 currency. But our next guest says he's not fully sold on the long-term flight to international stocks. Joining us with more, Krishna Mamani, Lafayette College's Chief Investment Officer. Krishna, great to have you on. I know that you don't buy the thesis that somehow foreign equities are going to do better on an absolute basis here. So what should investors do then if the Sell America trade might be sticking around for the short term?
Well, so I think that's an interesting challenge in that the environment right now is not good for equities on a global basis. So maybe the international stocks do relatively better than US stocks, but all of them are going down in the current environment. So for you to be a buyer of equities, you basically have to make a bet on this tariff threat and the ensuing potential for a recession that is on that is the cloud hanging over the market, fading in some way. And I don't think that is likely in the near term. So looking for places to hide in equity markets is probably not the wisest thing to do. I think cash or bonds probably ends up being the winner, at least for in the near term. From a longer term perspective, it definitely, if you have a recession, it definitely will be bonds a lot more than equities or even cash.
How much of a recession probability should investors be baking into their own portfolio, their own investment thesis right now? How much are you baking into your investment thesis?
So again, that's actually an interesting question as well. The economy right now has enough momentum for it to carry it through reasonably well until the middle of the year. Things are softening, but there was enough juice being provided through deficit spending and the momentum that we came into the year. So I think if there is a recession, that's probably in the second half of the year, far more likely than in the summer or earlier than that. So I think, and in the interim, the president may kind of change his mind, as he's akin to doing. So I think kind of getting out of equities altogether because of recession fear, and I know I'm talking both sides of my mouth right now, but I think that is not prudent either. The bottom line is having a significant view one way or the other is a fool's game right now.
I think, though, that you point to the challenge that so many of our sources have talked about on the show, Krishna, is that there's just not a lot of opportunity for conviction no matter where you look. And I heard you mentioning cash and bonds, which are also obviously, especially this morning, experiencing some pain as well. Do you have faith in U.S. Treasuries still, or would you be looking for bonds more globally?
No, I think if you're going to, as a U.S. investor, if you're going to invest in bonds, kind of trying to shelter yourself overseas in foreign bonds, it just hasn't worked out right. I know EM bonds are doing well, but if we have a recession in the U.S., the likelihood that the EM bonds are sheltered is just It's just not possible in my judgment. So I think if you're going to hide somewhere and you have a little bit of conviction around a potential recession, U.S. bonds is where it is. Otherwise, just stay in cash at the margin, because as I said before, having a lot of conviction in any viewpoint, earnings revisions, earnings growth trajectory, multiple surviving, not going into a recession, it's just, anything can change very, very quickly.
As I'm looking at some FactSet data here, Krishna, that was published late Friday, just before the long weekend, the forward 12-month PE ratio for the S&P 500 is about 19 right now. That is below the 5-year average, but still above the 10-year average. We had kind of a two-pronged hit to the market coming into, of course, this most recent earnings season that's just begun. One of them was self-induced on the trade war side, but then the other one was really more cyclical in some of the valuation calls that were out there, where a lot of analysts were saying it's just too pricey at this level. At this juncture, have we gotten back down to areas where it's warranted for investors to start picking and choosing some of the categorical winners more long-term?
So if you look at the equal weighted index and you look at the valuation of the equal weighted index, it is much, much better than the overall market. So your point is a good one. The sell-off is not just tariffs, it's about valuations of certain sectors in the market. So I think from a valuation standpoint, we are still high, but not as high as we have been since, as you said, 10 years, probably even longer from a valuation standpoint. So the downside, even in a recession scenario, is limited. If we were at 6,500, or let's say 61, 6,200, going to 4,800 was going to be very painful. Now that we are at close to 5,200, the downside in S&P is probably more like 4,500, which is much more limited than, because we have already come down a lot, and because of sell-off in tech and other related highly valued securities.
Krishna, I also want to talk to you about another looming uncertainty, especially over markets this morning, which is the independence of the Federal Reserve. President Donald Trump was asked about this on Thursday. Here's what he said.
Oh, he'll leave. If I ask him to, he'll be out of there. But I don't think he's doing the job. He's too late, always too late, a little slow, and I'm not happy with him. I let him know it, and if I want him out, he'll be out of there real fast, believe me. We have a Federal Reserve Chairman that is playing politics, somebody that I've never been very fond of, actually. But he's playing politics. Interest rates should be down now.
Krishna, just your reaction. What do you think about this?
I think the best course of action for the administration right now is just to continue to talk rather than convert that into actions, because in the middle of a tariff fight, if they go down that path, I think the Treasury market and the dollar would be hit really hard. So, the administration is somewhat unpredictable, so I can't say that they won't do it. But I think they know the consequences of doing it, and therefore it doesn't really serve their purpose to do anything on that front.
To what extent do you think the market is actually fading any action around this? Because let's be real and remind viewers that there are legal protections, regardless of whether or not the Trump administration has already shown in its 2.0 version that it's willing to just push everything to the courts, make the courts decide, and make them uphold the current term that expires in 2026. So Fed Chair Jay Powell has been vocal about that. The markets know that. So to what extent is this even playing out in the market right now?
Well, so it's extraordinarily difficult to tell what the driver is. I think people are looking at Treasury markets selling off and saying that that's because of Powell, talk of Powell getting removed. That may be the case. That may not be the case. Empirically, we can't really tell. I think it could be just equally well explained by the fact that the dollar is cratering because of hedging that is taking place for U.S. assets that foreigners own. Not the talk of Powell at all. That moving the dollar is, from a cyclical standpoint, isn't extraordinary. Yes, dollar was very strong and it has come down from that level. Given what is going on with the U.S. economy and the potential for tariffs, it could be just as well just because of that rather than Powell. So I think it's a nice story and it probably stays with us for a while, but I don't think that is the ultimate driver of things right now.
Krishna, great to see you this morning. Thanks so much for taking the time.
Thank you.
People around the world are paying tribute to Pope Francis, who passed earlier this morning at the age of 88. He battled with pneumonia in his final months, spending 5 weeks in the hospital before returning to the Vatican for the rest and recovery. Francis's final official meeting was with Vice President J.D. Vance. Vance writing in a post on X, quote, "I was happy to see him yesterday, though he was obviously very ill. May God rest his soul." Francis became the first Latin American pope in 2013, elected after his predecessor's surprise resignation, broadly believed to have breathed a breath of fresh air into the Catholic Church amid declining influence. Pope Francis put emphasis on helping the poor, being more inclusive, welcoming marginalized communities, and addressing climate change. Pope Francis's successor is not yet decided. Cardinals will meet in the Sistine Chapel for an election process that is shrouded in secrecy. They will burn the ballots to create a white smoke to signal when the new leader is chosen. It's now time for some of today's trending tickers. You can scan the QR code, but we're watching Nvidia, Taiwan Semiconductor, and Capital One. First up, Nvidia under pressure today as Chinese tech company Huawei. They are reportedly announcing some plans to begin mass shipments of its advanced AI chip to Chinese customers as early as next month. According to the report from Reuters, some shipments have already been made as Chinese AI companies look for domestic alternatives to Nvidia chips that now require an export license.
And next up, Taiwan Semiconductor warning of the challenges of export control compliance. The chipmaker saying it has limited visibility into the downstream use of its semiconductors. This coming months after a TSMC chip was found in a restricted Huawei Technologies processor.
Finally, Capital One's acquisition of Discover getting the green light from bank regulators. The planned $35 billion merger was the first announced in February of last year. And guess what? The deal will create the nation's biggest credit card issuer by loan volume. It's expected to close in May.
You can scan the QR code that was on your screen to track the best and worst performing stocks with Yahoo Finance's trending tickers page. There it is. Moving on to Tesla, set to report first quarter earnings this week. This as the EV maker struggles with falling sales. Joining us now, Garrett Nelson, CFRA analyst here. Garrett, great to speak with you. Shares of Tesla down a little, near 4.5% this morning. What are you anticipating this week?
Sure, thanks for having me. There's really two areas I think investors are going to be focused on. They're looking for clues that Tesla's auto sales will rebound from a very weak Q1 in which their sales deliveries were down 13% year over year. So, what will the updated 2025 sales guidance look like? Last quarter, they lowered their guidance pretty significantly, now expecting only growth, slight growth this year. So I think analysts have really taken down their estimates. We're now forecasting a 10% drop in sales volume this year. But that guidance is really going to be, I think, the number one thing that analysts are looking for. And then secondly, any information regarding the launch of their unsupervised full self-driving in the Austin market coming up in June, and as well as any update regarding their future product pipeline. So those are really, I think, the key things.
Garrett, comparing the PE ratio for Tesla to the rest of the automobile industry right now, and I know you kind of look across the entire automotive landscape and really assess what is different about all of these players right now, but Tesla is, 300x some of the other PEs that we're seeing within the industry and within the sector. What is it that investors are going to be expecting going into this call to make that PE ratio justified?
Yeah, it's a great question. It's always traded at a massive premium to the rest of the industry, though, and we think that's justified. So, Tesla is, of course, not only an auto company, but they're involved in energy storage, a business which is growing a lot faster than the auto business and has higher margins, robotics, AI, as well as we think the real value here is in the autonomous driving, the full self-driving software that they've continued to improve, and we'll really get a chance to showcase in June. I think everyone will be watching that. But I think Tesla has been really good the last few earnings releases at diverting investor attention away from the various near-term challenges that they face. And there's no doubt they're facing some challenges. EV market share losses across their three major markets of the US, Europe, and China, slowing EV demand growth, both domestically and internationally, ongoing pricing pressures, and disappointing Cybertruck volumes so far. So, and really diverting attention, keeping investors focused on longer term catalysts. And so they've done a really good job at that. And so I think as much attention will be focused on the conference call as there is on the earnings release.
Garrett, if I can nerd out with you for a hot second here, as we're thinking about full self-driving and some of the technological specs that go into that, they've faced criticism in the past from some customers, some investors, and technologists alike, who are trying to figure out, do they need to add more of a tandem approach and layer in LiDAR as well as some of the radar as backup versus just going off a camera-based system?
We don't think so, and we've been very impressed with the improvements that they've made, over the last few years, as we saw through different iterations of version 12, and now we're on version 13, and really ever since incorporating Nvidia's GPUs and AI into the development, they've made the progress has really accelerated in terms of the quality of the product and capabilities. So. Elon Musk has famously called LiDAR a fool's errand, and we don't see any scenario in which they would go back and say, you know what, we were wrong. We need to have LiDAR in addition to cameras and radar on the vehicle. So we don't see that happening. And the significance of the Austin rollout, of course, is that Waymo is already operating there with their LiDAR vehicles. So Tesla will be compared to the capabilities of Waymo's product.
I'm curious, too, about what you anticipate hearing on the call about the executive presence of Elon Musk. Dan Ives over at Wedbush saying this morning that Elon should step back from his work at Doge and focus on Tesla as the company faces a, quote, code red moment before reporting first quarter earnings. To what extent do you anticipate hearing more about how Elon Musk plans to spend his time amid the company's weak moment?
Yeah, we don't think there will be any update regarding that on the call, but we do think if he were to step down from his Doge responsibilities, that would be a big positive for the stock. In fact, a few weeks ago, we saw when a rumor came out that was coming, the stock very quickly jumped more than 10% intraday. So, in fact, it was the same day that Tesla reported their Q1 production and deliveries. So I think, that would be a big catalyst for the stock, and we actually don't think that's too far off. So, a lot of reports that could be coming, by late May. So, clearly, there's a lot more friction between Musk and certain members of the administration, and we wouldn't be surprised. That's another reason why we would buy the stock here. Following this big sell-off, the stock has essentially done a round trip from where it was just prior to the election in mid-October, when it ran up to almost $480. It's back down to where it was just prior to the election. So, and we actually like the risk-reward profile here.
Garrett, I only got about 15 seconds here, but do you believe that there's been an erosion of some of the customer sentiment because of Musk's annexation to President Trump and the White House, not just here in the U.S., but internationally?
Yeah, no question there's been some damage to the brand. And I think, that was really reflected in the weak Q1 sales numbers. The production lines were down across all their factories in Q1, so that had an impact. But I think that's what investors are really looking for, evidence of a rebound starting in Q2. Donald Trump's purchase of a Tesla vehicle really had a positive impact on their sales in the near term when that happened last month. So, to what extent that carried through and is going to show up in their Q2 sales number remains to be seen.
Garrett, we're going to be watching the report. We know you will be too. Thanks so much.
Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. They're taking a live look and listen in to the opening bell at the New York Stock Exchange. Fundstrat ringing the opening bell there. You got some friends of the show. Actually, Mark Newton from Strat up there as well, ringing the opening bell on Wall Street. And then you've got Progeny ringing the opening bell at the NASDAQ in celebration of and recognition of National Infertility Awareness Week. Got some funfetti taking place there in Times Square as well. All right, let's take a look at how the major averages begin today's trading session. You've got the Dow Jones Industrial Average right now starting off the day down by about 0.7% as we begin today's activity. Let's put a chart on this just so you can get some ideas of exactly how we've been faring coming into this. We'll put a year-to-date chart on this, why don't we? Still down by about 8.7% year-to-date here, but the Dow opening up off by about 290 points. The NASDAQ composite, you're seeing that open up lower by about 240 points to begin the day. That's a move lower of about 1.5% year to date, still deep in decline there. That's down 17-ish%. And then you're taking a look as well at the S&P 500, that down to begin the day by 1% coming out of the gate. There's a lot rattling through the markets. And of course, as investors continue to digest exactly what some of the tit for tat and continuous movements within trade policy continues to look like, both out of the White House and out of some of the international elected officials and dignitaries. So we'll continue to watch that and how those discussions continue to move forward here at this juncture, though. And as we're taking a look more over to the heat maps, let's take a look at the sector activity here. 11 S&P 500 sectors we've got them pulled up here for you on the screen, and just one in positive territory right now to begin today's trading action. That is consumer staples. That's flat, just barely to the upside, but 10 out of 11 S&P 500 sectors in the red to begin the day. Those declines being led right now by XLE, energy, and then you've also got technology down by about 1.5%, kind of mirroring what we were seeing in the tech-heavy NASDAQ a moment ago here, and consumer discretionary, that's also down by about 1.5%. I want to take a look at that NASDAQ as we're pulling up that NASDAQ 100 board here on the day. We were just talking about Tesla a moment ago. Of course, the company reporting earnings this week. We're going to be watching very closely for that and what the brand of Musk has to say about what they're seeing in demand for its vehicles. But as of right now, Tesla, you're seeing that beginning the week down by about 4.5%. A lot of the other Mag 7 names in negative territory here on the day. And I actually just want to spend a little time there and just linger on that for a hot second because of some of the mega cap tech stocks. Think about companies that are $200 billion or more. You're seeing many of them in negative territory for performance year-to-date scale. Some of those declines led by names like Broadcom, Salesforce, ticker symbol CRM. You've got Nvidia, TSM also down. All of these down more than 20%. Apple and Microsoft kind of rounding out that list. Well, Apple rounding off that list. And let me put this on a year-to-date scale so you can actually see what those declines have looked like year-to-date, and you can get a little bit more of a sense of what I'm talking about here as well on our heat maps. But you have three that are outperforming as of right now. Holding on to gains, you've got Palantir, that's still up by about 24% year to date. We'll see if we can spot that very quickly here within ours. Yep, there we go. PLTR, that's up by about 25% year to date. It's moved off of some of those lows that we had seen. And then additionally here, you've got SAP and IBM still in positive territory. Big Blue and, of course, SAP, one of the more international names, that's continuing to hold on to some gains as of right now. Also, though, with the time that we do have, I want to take a look at crypto here for a hot second, because you still have, even though Bitcoin here on the day, and that we were taking a look at the year to date, I believe, a moment ago. So let me put this on the intraday move. I didn't want to catch too many of you by surprise as of right now, but Bitcoin is still up right now. It's up by about 3.5% here. And here's what's key about this level that we're seeing right now, and this will help us actually get into a little bit more of the technicals. As we've been within this trend lower here, one of the keys was that we've actually broken above this top end resistance of that band, and that's exactly where a lot of the traders were continuing to try and signal or look for signals of bouncing through and breaking out of that trading range lower here. So some of the larger questions is if we can get back to that 90,000 range, does that signal even more of rally mode for cryptocurrency, for Bitcoin specifically here? But as of right now, you saw that sitting at about 87,000. That after it had already kind of set in some of those lows at around the 75K range. So we'll continue to track cryptocurrencies. And then just lastly here, we'll ride out with a look at the Dow 30 components. A lot of us hold these and of course our retirement accounts and whatnot. You're seeing a lot of red on the screen to start the day here. And that is led by Boeing and Chevron, two of the biggest decliners in the pullback, but IBM, Disney, Travelers, they are leading the pack as of right now. Maddie, I'll toss things on over to you.
All right, Brad, thank you so much. Appreciate it. It's time now for today's strategy session. The U.S. dollar and Treasury selling off in tandem as investors assess the economic risks of President Trump's threats to fire Fed Chair Jerome Powell, with the bond market's safe haven status in question amid risks to the Fed's independence. Joining us now, Michael Gousset, Principal Asset Management Chief Investment Officer of Global Fixed Income. Michael, great to have you on here. Just to get a sense, we understand the legal pushback. We understand that the Trump administration has been pushing for and investigating a way to fire a Fed chair previously, and they haven't been able to find a way. But hypothetically, how bad would a firing of the Fed chair be for financial markets?
Good morning, and thank you for having me. It would be bad. There's no doubt that the uncertainty that already exists with regard to tariffs, how that plays out in terms of growth prospects going forward, are undermining some of the markets that were just referenced. Certainly, if we go forward and start to think about just the overall security and trade apparatus that have been dominated by the U.S. for the last 40 or 50 years coming into question, you're seeing that undermining the value of the U.S. dollar. If the independence of the Fed, which is ultimately what you're talking about, comes into question and is actually realized, I think that would further put downward pressure on the confidence that foreign investors have in investing in U.S. dollar assets.
You know, I wonder, because the Fed right now, of course, continuing to be as data dependent as ever, they're continuing to try and figure out in the different data prints how that's going to impact their own policy pathway, but also for, major chief investment officers like yourself who are looking across the fixed income space. I wonder how that's influencing in the data prints what you've seen kind of on aggregate to influence the fixed income investment strategy right now.
That's a good question, because I think the troubles that the Fed is having is the same that we're having as investors, which is all the data that's coming out now is stale. It doesn't matter anymore. It's really with a different regime, effectively, in terms of how the markets are going to behave. So as we go forward, the Fed is data dependent. But I think what the Fed, as well as most investors, understand is that tariffs, as they stand today, are inflationary. They erode growth. And you don't need to see a lot of hard data start to show up to support that soft data, which has already been coming through weaker, to suggest that a significant slowdown is on the horizon. Now, we don't think we're seeing a recession imminently, but the longer this uncertainty persists, the more likely you're going to see that play out.
When might we see that soft data turn into hard data and tip over to indicate that these tariffs are causing a real risk to the economy?
It's probably another month or so before you really start to see that hard data show the deterioration that we all expect. I mean, you certainly have heard anecdotally from CFO surveys and companies themselves as they release earnings with really no guidance. That should undermine some confidence that M&A and capital expansion, as well as hiring plans, are definitely being put on hold. And so as long as that persists, you will see that show up in hard data, which could be as soon as May.
And that's really good context, I think, for the audience, just in terms of when we will see that tariff momentum playing out in economic data. I do want to talk to you about some evidence we're seeing in bond market moves, specifically the 2s10s yields curve here, hitting a new cycle high. What does that tell you about the degree to which the term premium is rising for investors and what that tells you about sentiment?
Yeah, I think there's two pieces in there. One we hit on earlier, which is those international investors who are a large supporter of the U.S. Treasury market. Perhaps are getting a little nervous, whether that's related to some of the government uncertainty and policy uncertainty or growth uncertainty and inflation uncertainty. But regardless, that's undermining some of the confidence that they have. And as a result, you're seeing more term premium need to be priced into the market to incentivize them to invest in the U.S. Treasury market. While simultaneously, this understanding that we're having some weakness, that although we don't necessarily think, again, that this is guaranteed recession, but certainly is a slowdown from here, that puts the Fed firmly into action in terms of potentially cutting rates, which does tend to have a steepening effect on the yield curve.
Michael, good to speak with you this morning. Thanks so much for taking the time.
Thank you.
Let's get a check-in on shares of Netflix. As of right now, you're seeing them Trading higher this morning after the streaming company reported record profit to start the year, easing concerns of a slowdown or fears the streaming leader might be hurt by growing economic uncertainty. Investors have come to see Netflix as a safe bet during a time of great economic uncertainty and challenges for conventional movie and TV businesses with a global audience of more than 700 million viewers. The company said it has seen no impact on its business from President Donald Trump's tariffs or the market volatility that has followed. The most recent earnings mark the first time Netflix has reported financial results without disclosing how many customers it added or lost. We're continuing to keep tabs on shares of Netflix, as I mentioned a moment ago, shares higher to start off today's trading session.
Coming up, Google facing off against the DOJ and Meta's FTC trial entering its second week. We're going to break down what this wave of antitrust action means for big tech. Stick around. Alphabet and the Department of Justice returning to court today to begin a case that will help determine whether the company is required to sell its Chrome web browser. In a separate case that was decided last week, Google was ruled to have monopolized aspects of the online ad market. Joining us with more on what the current wave of antitrust cases means for U.S. companies, we've got Rohit Chopra, former FTC Commissioner. Rohit, great to have you on this morning, and we'll get to Meta, which you obviously played a key role in that case as well at the beginning, but I want to start with Google. Where do you anticipate this going? Is there a likelihood here of Google being broken up?
Well, I think what everyone agrees with is that we're all better off when the internet is free, fair, and really open for new business. And we wouldn't have a Google or a Facebook if there was not antitrust action against Microsoft a generation ago. So where Google stands is it's essentially been told it's guilty on two fronts, including a really important part of our economy, which is online ad sales. So the judge has ruled that Google has engaged in an illegal monopolization scheme. And now the next step is to determine how to restore fairness in this market. We all want to see advertisers get a competitive rate for their online ads. And we also want to see local media and small content creators be able to monetize. And Google has been taxing both sides, and the court will now determine how to fix that.
You know, Rohit, I was taking a look at what the remedies proposal looks like coming forward from Google, and I'm sure you've already kind of dove into this as well, and I just wonder, of the remedies that they're talking about with regard to browser agreements and Android contracts as well, and then the third prong of it, which was oversight and compliance, which allows them essentially to retain that oversight and compliance, but do some more regular reporting from my own kind of summation of it without giving the government kind of excessive oversight into it. Does that check any of the boxes that are being put forward here in these proceedings?
Well, as you can tell, Google has all sorts of ways in which it has inserted contract clauses or otherwise wielded its power. Big picture, we know that spin-offs can be a really important part of this. In the ad network case, it's almost as if it's the equivalent if a large investment bank owned the New York Stock Exchange. That's how Google's ad business works. In search, it's a little bit different. So what I'd like to see is really a hard look at spin-offs. Often spin-offs can create a lot of investor value and value to consumers and businesses. And I'd also like to see that any type of contractual clauses that are coercive are not able to be enforced by Google. This will help bring us back to an internet that was more open protocols where everyone can jump in.
Rohit, you cast the deciding vote to initiate this Meta trial back when you were at the FTC. Do you believe that Meta was engaging in a buy or bury scheme? And what is your best estimation then of where this trial ends, if you think that is how the court will decide Meta has been handling things?
Well, that original vote was around 5 years ago, and that was after years of investigation. And what the investigation revealed was Facebook really was scrambling when mobile took off, and they saw Instagram and other apps really eating their lunch when it came to new ways to connect through mobile. And rather than actually devoting the money and expertise to innovate, they just bought those apps off, or if they wouldn't sell, they would use all sorts of mischief to make sure that they couldn't get traffic through Facebook. So to me, this is pretty off the rails. We want technology companies to offer better and better services to consumers, to increase privacy protections, to not load their apps with scammy ads. And what we sometimes see is the big guys are threatened by the upstarts and they want to take them out. So that's what we're seeing and learning in this trial. We're even seeing in Mark Zuckerberg's own words, him being very clear in writing about this scheme. And so the trial will play out, and I hope this is a signal to existing big tech companies that this type of conduct is illegal.
Rohit, just while we have you here, how is this setting precedent as well for what we could see within deal making going forward from this juncture? Because coming into and even right after the election, there were private equity firms, there were major investors that were talking about how deal making was going to be all the rage and in vogue once again because Trump was seen as more business friendly and more deal maker friendly, and that we could see all of these massive deals come forward. What is this doing to potentially dampen some of that fervor?
Well, a lot of the M&A has not taken place because of the chaos of economic policy we see today, uncertainty about the rate environment, and so much more. So I don't know if we should be really crying for those who are not able to engage in big M&A when it's anti-competitive. I think what we want to see is when these small, mid-sized companies are really gaining steam, especially in technology, I think America really benefits when they can go public or when they can grow and really challenge the big guys. I just don't know if it makes sense to have an economy where companies form solely for the purpose to be eaten up by a dominant incumbent. We don't want to be like Europe or like China. The reason why I think we have led the way in technology is because we create the conditions for new startups to emerge, but we want them to be able to overthrow the existing crew that dominates. And that just feels the best way for American markets and capitalism to work.
Rohit, thanks so much for taking the time here with us this morning.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching The Morning Brief. Gold prices are surging to yet another record high as investors weigh concerns over President Trump's criticism of the Fed and an escalating trade war. Yahoo Finance senior markets reporter CFRA has the story. Hey, Inez.
Hey, Brad, and we are seeing gold at all-time high levels right now, with President Trump just about 10 minutes ago posting another post on Truth Social criticizing Fed Chair Jerome Powell. So you are seeing right now gold futures at $3,436 per ounce. I do want to mention the U.S. dollar, which has been under pressure. This has been sending gold prices higher at, high after high that we've had year to date. We are looking at gold up 30%. You've had Wall Street really upping their price targets on the precious metal. Goldman Sachs last week saying that gold will reach 3,700 by year end. Perhaps an upside risk would be even going higher than that by year end. And Goldman Sachs even also noting that despite these record levels, they're saying that this is still a good entry point because they're noticing that we've had very few dips over the last month. And when we have had some dips, you have seen Asian official buying, i.e. that means the Chinese central bank, guys.
All right, Inez, great overview there. Thank you so much for joining us. We appreciate it. That's going to do it for the morning brief this hour. You can join me in the next hour for more analysis on catalysts, and then Brad for wealth after that.